NLY Capital is probably one of the most popular high-yielding dividend stocks out there for people seeking income. I remember years and years ago reading financial magazines like Kiplinger pushing this stock as being a top pick for retirees seeking income. But given this year's market conditions, as of the making of this video, their stock today now yields over 21.5%. The share price of NLY Capital has also fallen significantly more than the S&P 500 and really most other companies in the same sector. Considering the huge discount, I thought in today's video it'd be a good idea to basically take a look at NLY Capital and try and determine if this stock is worth considering and where this company might be headed in the future. So NLY Capital Management, ticker NLY, is a capital manager with investment strategies all across mortgage financing. They hold investments in agency mortgage-backed securities, mortgage servicing rights, agency commercial mortgage-backed securities, and other types of MBSs. NLY is structured as a mortgage real estate investment trust, meaning that 90% of the company's earnings have to be paid to shareholders in the form of dividends. This explains how many REITs, and especially mREITs, have such high dividend yields. Many were yielding around 8 to 10% before 2022, whereas now we're seeing mREITs yielding 12 to 15%, or in NLY's case, even over 20% in certain situations. There's a few reasons why NLY in particular was such a popular high-yielding dividend stock and was highly esteemed for many years. They're one of the oldest, if not the oldest, publicly traded mortgage REIT in the industry. This company was founded all the way back in 1996, which beats out MFA Financial by 1 year, so I'm really not aware of an older publicly traded mREIT that's still out there. NLY is also the largest mortgage REIT in the industry. As of June of this year, this company had a total portfolio value of $82.3 billion and total shareholders' equity of $11 billion. Not to mention their stock performed moderately well for more than 20 years after their IPO. The company just also went through a reverse stock split, which I'll touch on more later. It pays quarterly dividends, with their last being for 88 cents per share. With that exceptionally high dividend yield, it's no wonder why so many dividend and income investors are drawn to NLY Capital. A $10,000 investment into this stock today would result in a quarterly dividend distribution of $540.32, or if you divide it by 3, roughly $180.10 a month. And imagine adding another zero to that $10,000 investment and making $100,000 worth of this stock, and you'd be getting over $1,800 every single month. Odds are that for most of us, that would probably cover your mortgage. But we need to take a deeper look into this company and determine if that would actually be a good idea. Let's start by going over what exactly a mortgage REIT or an mREIT actually is. They're a financial business that provides financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities and earning income from the interest on those investments. mREITs fund these investments with equity and debt capital. The goal is to earn a profit from their net interest margin, or the spread between the income interest on their mortgage assets and their funding costs. They rely on various different methods of funding sources, including common and preferred equity, repurchase agreements, structured financing, as well as convertible and long-term debt. As you can imagine, with rising interest rates this year, things have been pretty awful for most mortgage REITs. But not all of these companies are created equal, in that some mREITs do perform better than others depending on what they specialize in. For example, some mREITs issue their own mortgages, like Blackstone Mortgage Trust, ticker symbol BXMT. A couple mREITs specifically focus on bridge loans, which are safer than some mortgage-backed securities, with an example being Arbor Realty Trust, ticker ABR. Some mREITs specialize in mortgage servicing rights, like Rhythm Capital, ticker RITM. And then a couple mREITs actually issue their own mortgages and own physical real estate, just like an equity REIT, with an example being Starwood Property Trust, STWD. But NLY doesn't specialize in any of these areas. NLY purchases already existing mortgages that are in mortgage-backed securities. They do also invest in mortgage servicing rights and a couple other areas, but they're really a minuscule part of their overall business. The overwhelming majority of their investment portfolio is in mortgage-backed securities. mREITs that focus on MBSs have performed the worst out of all these types of mREITs out there over the last decade. Some other companies that only focus on MBSs would include Orchid Island Capital and Armor Residential, both of which have been demolished over the last decade. Just by expanding the share price performance, we can see NLY's been going on a downward trend since 2013. From 1997 until late 2012, NLY was a really decent performer in terms of their share price. But starting in 2013, things took a downturn when the share price fell by more than a third in just 1 year. It recovered in mid-2017, but then it fell again. The share price never recovered to its pre-pandemic price, and fast forward to today, the share price of NLY Capital has dropped by almost 40% in just the last month. But maybe you're thinking, what if this stock makes a comeback? Maybe now would be a good time to get in on it. That could be the case, but now let's turn our attention to the financials of this company. Anytime you're looking at a mortgage REIT, you absolutely must look at the book value of the company. In my opinion, this is the most important financial metric to look at for an mREIT. It's really easy to do, and you can find it on the balance sheet on their financial statements. You can use a website like stockanalysis.com, which gives you 10 years of financial performance history for a company, and it presents it in a graph which is much more appealing to look at. All you have to do is type in the ticker symbol, click on financials, and then go to the balance sheet. Make sure you're looking at the quarterly results and not the annual. If you see a steady decline in the book value every quarter or nearly every quarter, a dividend cut is most likely imminent. That's because the book value for an mREIT represents the total number of mortgages an mREIT owns. If this number is going down, it means the company is losing mortgages and therefore they'll have less money to pass on to investors in the quarters ahead. In NLY's case, you can see the book value has been absolutely demolished over the decade, and it's even sped up this year compared to previous years. Just by looking at this, I'd say future dividend cuts are extremely likely for this stock. Let's compare NLY to some better mREITs. When we look up Arbor Realty Trust, ticker ABR, we see a completely different situation. Their book values continue to grow for years and just recently went down a little bit this year. This indicates to me that this is a much safer dividend yielding stock, and based on what I'm seeing, I'm not noticing anything that would indicate a dramatic cut is imminent anytime soon. If it does keep dropping in the quarters ahead, then a cut may be a real possibility. Let's also take a look at Ready Capital, which is another mortgage REIT that I featured last week. You can see their book value has been pretty stable since 2016 with a couple small decreases here and there. Another concerning trend for NLY Capital is the fact that they've been increasing their leverage on their debt portfolio. A lot of different high-yielding investments, including mREITs, BDCs, and closed-end funds, use leverage in order to boost income returns. It's a strategy that always comes with risk, because even though when times are good it can boost returns even more, during bad times it can magnify losses. In your mind, you should always view higher leverage translating into higher risk. The fact that NLY's been increasing their leverage over the last 5 quarters is another concerning metric for this company, in my opinion. They've been taking on more risk in order to boost returns, but this obviously hasn't been working for them. You can also see by looking at their past dividend history over the last 10 years, NLY's reduced their dividend 9 times during this period. Back in 2013, they even reduced their dividend 3 times in just 1 year. Compared to what the company paid back in late 2012, NLY's reduced their dividend amount by 60%. Remember how I mentioned earlier in the video that they just went through a stock split? On September 8th, the company announced a reverse stock split of 1-4. This means for every 4 shares of NLY Capital that you'd own, you would now own just 1 share. You don't lose any money because the reverse stock split increases the share price of their stock in an equal amount, or by 4 times in this case. Speaking of which, Orchid Island Capital just went through the exact same thing when they did a reverse stock split back in August, but theirs was even worse at a 1-for-5 reverse split. The strategy of implementing a reverse stock split is nothing more than a way for these companies to try to cover up their plunging book values. For both NLY Capital and Orchid Island, both of their share prices were about to be at or were currently at penny level prices. But doing reverse stock splits actually increases the stock share price. In my opinion, management is simply trying to cover up their poor stock performance, hoping that investors won't notice. So looking at everything we've seen, I'm not optimistic about NLY Capital. But there could be better times ahead for this company if interest rates start to go back down. But I'm still concerned about their poor performance and that reverse stock split, because it seems the company is more concerned about their stock's performance rather than their company's performance. I think that both their financials and their share price show that the management team hasn't been doing a stellar job over the years. And based on what we've looked at, I'm not too optimistic about this company going forward.